Right now, the U.S. economy is trapped in a specific, contradictory state. Hiring has stalled out, yet companies aren't laying people off in mass numbers. We can see this tension clearly in the weekly data. Initial jobless claims, the number of people newly filing for unemployment, hover right around 226,000. But this chart plots a different story on the back end. While initial claims stay flat, that rising line represents continuing jobless claims approaching 1.81 million. People aren't losing jobs, but those who do are struggling to find new ones. That shaded zone between the two lines defines our current reality, a strict low-hire, low-fire labor market. For anyone managing a portfolio, this data matters a lot more than the headline unemployment rate. It tells us the economy has lost its forward momentum, but hasn't broken down enough to force an emergency rescue. We are staring at an economy that hasn't crashed, but certainly isn't moving forward. We are simply idling in place. And this stagnant employment data dictates what the Federal Reserve will do next with your money. Think of the Federal Reserve as the main faucet for global economic liquidity. Because the labor market refuses to crack, the Fed is forced to keep that faucet closed. The people in this room look at that stubborn data and decide to hold interest rates higher for longer, ensuring lingering inflation doesn't reignite. This creates an immediate problem for investors. Sitting in cash and waiting on the sidelines for cheap money to return and inflate your stocks is no longer a viable short-term strategy. To protect your purchasing power, you must proactively allocate capital into assets designed to preserve wealth. Today, investors face a choice between two primary safe haven contenders: the millennia-old standard of physical gold and the emerging digital alternative of Bitcoin. You need a wealth preservation vehicle, but that choice requires understanding two vastly different risk profiles. Let's look at how these assets behave when the economic weather finally breaks and the Fed decides to signal a rate cut. A Fed rate cut lowers borrowing costs and reduces the opportunity cost of holding assets without a monthly yield. When bank deposits stop paying attractive rates, fresh capital flees and floods into alternative stores of value. Historically, gold reacts exactly as you would expect. It rises steadily and reliably, proving its worth as a traditional hedge against currency devaluation. Bitcoin reacts like a sponge for excess liquidity. It surges aggressively, behaving more like a high-beta tech stock than a traditional commodity. Cautionary, but that behavior reveals an immediate trade-off. To get that massive upside potential, you have to endure intense, nerve-wracking volatility along the way. Both assets will appreciate when rates eventually go down, but their velocity and their volatility are completely different beasts. Now, let's look at the reality we face today, a Fed that maintains a tight money stance or even signals a sudden rate hike. This document outlines the hawkish pivot. When the Fed promises to keep rates higher for longer, it strengthens the US dollar and pushes up guaranteed yields on Treasury bonds. With a guaranteed 5% return on cash or government debt, the opportunity cost to hold gold or Bitcoin rises sharply. They become far less attractive. In this environment, gold suffers a textbook downward correction. The price drops, but it generally maintains a stable, historically proven floor. Bitcoin's reaction is far more severe. Because it trades so heavily on expectations of future liquidity, a tight money signal triggers violent, rapid drawdowns. During these liquidity crunches, Bitcoin strips off its digital gold armor and acts just like a risky tech equity. In a tight money environment, both of these assets bleed. But Bitcoin's extreme sensitivity to the macroeconomy exposes investors to a much higher short-term risk. Take away the Fed's daily influence, and gold's core utility is clear. It provides physical, tangible price stability through actual wars and economic collapses. The trade-off? You sacrifice outsized returns, and you have to navigate the logistics of physically storing it or trust a paper ETF to hold it. Bitcoin offers a completely different utility. It is globally accessible, purely digital, and its supply is algorithmically hard-capped at exactly 21 million coins. Since its creation in 2009, it has massively outperformed every traditional market index, steadily growing into a viable alternative financial network. Measured, so here is the ultimate trade-off. Gold offers supreme downside protection at the cost of aggressive growth. Bitcoin offers exponential growth at the cost of extreme short-term vulnerability. To make an informed decision, you have to map these trade-offs directly to your psychological goals. If your primary goal is to preserve wealth and minimize daily stress, your allocation arrow points firmly to gold. This path is for the wealth preserver. You may miss triple-digit gains, but you avoid 50% drawdowns. If your goal is maximizing long-term growth and you tolerate steep drawdowns, your arrow points to Bitcoin. This suits the digital optimizer, someone with a multi-year time horizon and the iron stomach required to endure massive price swings triggered by minor economic reports. There is no universal best safe haven, only the asset that matches your psychological fortitude. Regardless of your choice, there is an intense temptation right now to actively time the market based on weekly jobless claims or Fed press conferences. If you try to trade these news cycles, you end up competing directly against lightning-fast institutional algorithms and constantly shifting macroeconomic data. This reactionary approach incurs high fees, causes severe emotional stress, and guarantees buying high, selling low. The actionable alternative is simple. Define your safe haven allocation and your strict risk tolerance completely before the economic weather changes. Whether you rely on the analog certainty of gold or the digital upside of Bitcoin, true wealth preservation comes from holding your chosen asset through the noise of this lo-fi economy.